So guys, this is another good question from a medical resident, someone who's a physician and young resident who's also moonlighting on the side, right? So they make about 100,000 of W-2 income and about another 2,400. It's not clear if that's per month or in total for the year. So he's saying, is it worth creating an LLC or S Corp for the side moonlighting money? Which is a really good question. So let's assume that it's 2,400 a month that he's getting paid moonlighting as part of this resident gig that he's doing on the side. So $2,400 a month times 12 is $28,800. So in that case, of course, there's going to be some taxes he's going to have to pay on that. As far as an LLC goes, usually that depends on a number of factors. But in this case, since he's in the medical space and he's actually working with patients, I would suggest potentially setting up an LLC just because remember, guys, an LLC protects you from a legal standpoint. So if there is ever a situation where he gets sued for maybe a malpractice or anything like that, it would be good to have that legal protection that an LLC provides. But also, I would also recommend that he, at the minimum, should have very good professional insurance that covers his practice and whatever he's also doing on the side. And if he has that and it's very strong and covers anything that could happen, he might not need to set up an LLC right now. Just have it as a sole proprietorship, which he doesn't need to do anything for except for signing up and getting an EIN from the IRS. Now, the other side of this is the S Corp. And in this case, it's absolutely not necessary, right? Now, think about it here, guys. The S Corp, he's going to be having to maintain the S Corp. There's going to be maintenance costs that are associated with that. There's really not going to be any tax savings if he's making $28,000 on that S Corp. So he's not going to be saving anything as opposed to just having that as an LLC, from a tax standpoint. And he's going to have to file an extra tax return for that corporation, which will include extra costs, along with the cost of having to set up payroll and potentially, depending on the state that he's in, having to comply from a state standpoint as far as that S Corp is concerned. So guys, it's important to always think about just the potential implications of setting up an entity or an organization. In this case, I would recommend he consult a CPA to engage in some tax planning at the very least to determine what that end of year tax liability would look like. And that way he'll at least be able to avoid surprises at the end of the year on that 1099 income. Because again, the IRS is going to want their share of that. If he's not sending those taxes in on a quarterly basis, then there's probably going to be some interest that's accruing along with that actual tax that he's still going to have to pay at the end of the year. And the goal here is to avoid surprises. For more helpful tips and advice from a CPA, follow me. Talk to you guys later.